Since the global financial crisis of 2008, total global debt has surged by over $100 trillion. It didn't stop when normal growth returned, it didn't stop during record low unemployment, and it didn't stop during a worldwide bull market. In fact, it has accelerated over time. Governments, corporations, households, nearly every corner of the global economy has become dependent on debt. Today, the world owes more than $300 trillion, nearly 340% of global GDP, according to the Institute of International Finance. The question isn't who is borrowing anymore, it's who isn't. Despite periods of prosperity, debt keeps rising. That isn't an accident, it's structural. Today, I want to talk about why the modern economy is built on ever-increasing leverage, and why, despite all the risks, there seems to be no turning back. But before we get started, please take a second to hit that like button and subscribe. I post a new video for you guys every weekday, and it really helps out the channel. In 1944, the world tied its currencies to the US dollar, and the dollar to gold. This was the Bretton Woods system, designed to bring monetary order after World War II. But by 1971, mounting deficits and foreign claims on US gold forced Nixon to end the gold standard. The result? Fiat currencies, unbacked, floating, and sovereign controlled. In other words, money that has value because we say it has value. This shift created enormous flexibility for governments. They could now borrow and spend without the hard limit of gold reserves. Over time, this freedom encouraged fiscal expansion, especially when political cycles rewarded short-term boosts over long-term stability. But that was only part of the puzzle. In the 1980s and 1990s, financial liberalization accelerated. Deregulated banking, expanded capital markets, and the rise of derivative securities made it easier and cheaper for everyone to borrow. At the same time, central banks began targeting inflation more aggressively than debt levels. Stable prices became the goal, and low interest rates became the tool. And as interest rates fell, debt naturally rose. Households took on larger mortgages, companies used credit to fund expansion, invest in productivity, and increase shareholder returns. Governments ran consistent deficits, with borrowing costs remaining relatively low. On the surface, the system appeared to function smoothly, but these patterns quietly introduced new vulnerabilities. Debt, when sustained over time and across sectors, changes economic behavior. It shifts incentives, it amplifies downturns, and it concentrates risk in ways that aren't always visible until something breaks. By the time the 2008 crisis hit, global debt had ballooned, and the solution to the crash, ironically, was even more debt. Central banks slashed rates to zero. Governments passed multi-trillion-dollar stimulus packages. Debt wasn't just tolerated, it became essential. Post-2008, the rules of economic management changed. Central banks became the first line of defense, and their main weapon, interest rates, was already maxed out. From 2009 to 2022, the world experienced the longest sustained period of low interest rates in modern history. The US federal funds rate spent 7 of those years at essentially zero. In Europe and Japan, some rates even went negative, which I plan to talk about in an upcoming video. Why? Well, because the alternative, higher rates, less borrowing, and tighter credit, risk tipping already fragile economies back into recession. The longer rates stayed low, the more the system adapted to them. Businesses began borrowing for everything from mergers and acquisition to stock buybacks. Consumers took on more housing and education debt, and governments leaned into deficits, assuming debt servicing costs would remain manageable. This is known as path dependence. Once an economy grows around cheap credit, pulling it away can be catastrophic. When inflation returned in 2021 and central banks were forced to hike rates aggressively, as we know, this triggered banking failures, housing slowdowns, and sovereign debt stress. And here's the kicker. High debt levels make it harder to raise rates without crashing the economy, but low rates encourage even more debt. That's the trap economists call fiscal dominance, when monetary policy becomes a servant to public debt sustainability. Under ideal conditions, an economy grows through innovation, productivity, and labor force expansion. But what happens when those engines slow down? Well, in developed economies, populations are aging and shrinking. Countries like Japan, Germany, South Korea, they're all facing demographic headwinds that naturally slow their economic growth. At the same time, productivity growth, the efficiency with which we turn inputs into outputs, has been pretty sluggish. From 2010 to 2019, U.S. productivity grew at less than 1.5% per year, according to the Bureau of Labor Statistics. That leaves policymakers with few levers to pull. One of the most reliable, demand stimulation through debt-financed spending. When the private sector slows down, the government steps in. Infrastructure, welfare, tax cuts, whatever it takes to keep aggregate demand from collapsing. And in a world of global capital markets, there are always lenders willing to buy sovereign bonds. But this dependency isn't limited to governments. Corporations now rely on cheap debt to finance operations, maintain shareholder returns, and stay competitive. Households need debt to afford housing, education, and increasingly even healthcare. Debt fills the gap when organic growth falls short, but it also obscures the weakness underneath. And that creates a dangerous illusion that the economy is stronger than it really is. The idea that you can grow your way out of debt isn't just hopeful, it's historical. After World War II, US debt to GDP exceeded 120%. But by the 1970s, it had fallen below 40%. The catch? Well, GDP was growing at more than 4% per year, and inflation helped erode the real value of debt. Compare that to Japan. After its 1990 asset bubble burst, Japan entered what became known as the lost decade. Despite massive fiscal stimulus and near zero rates, growth remained pretty low, and debt to GDP climbed past 250%. The difference lies in demographics, productivity, and external demand. Japan aged quickly. The US in the 1950s did not. So the theory is simple. If an economy grows faster than its interest burden, the debt shrinks relative to GDP. But in today's environment of low growth and rising rates, that formula is pretty difficult to sustain. That leads us to a second option, inflation. High inflation reduces the real value of debt because while the nominal amount stays the same, the value of money falls. Debtors benefit, but savers lose out. It acts like a hidden tax, shifting wealth from creditors to borrowers. But inflation also comes with side effects. It raises economic uncertainty, undermines financial planning, and can spiral out of control if not managed carefully. Households may rush to spend rather than save. In the long run, inflation can weaken institutions and social trust. Which brings us to our third option, some kind of reset. When debt becomes unsustainable, history offers a limited set of outcomes. One is restructuring. Argentina, Greece, and others have renegotiated their sovereign debt, but at great economic cost and long-term damage to their credibility. Another is financial repression, capping interest rates below inflation to slowly erode debt. This was used after World War II in the US with capital controls and mandatory bond purchases. But it distorts capital allocation and disproportionately punishes savers. Then there's modern monetary theory, which argues that as long as a country issues its own currency, it can never run out of money, only real resources. But critics point out this approach risks runaway inflation and a loss of any semblance of market discipline. So far, no large economy has truly adopted modern monetary theory in full, but many policies during the pandemic era resembled it. Central banks monetizing government deficits, direct payments to citizens, and massive fiscal expansion with few immediate consequences. The long-term effects of these policies still remain unclear. What is clear is this: we're unlikely to find a painless exit. Every solution, from deep spending cuts to inflation to restructuring, comes with its own set of trade-offs. And as debt grows, those trade-offs only become harder to manage. So to wrap this up, debt is no longer a lever we pull in times of crisis. It's kind of the scaffolding holding the whole system together. From central bank policy to corporate strategy to household budgets, debt has become embedded in the structure of modern economies. And the longer it persists, the harder it is to imagine a world without it. But structural debt isn't just a financial issue. It shapes how governments govern, how companies invest, and how societies define opportunity. It magnifies every shock and limits every response. In this sense, the question isn't whether debt is good or bad, it's whether the system built on it can evolve before it collapses under its own weight. Because the one thing debt can't buy is time. If this helped you see the bigger picture, please consider subscribing and hitting the like button. It means the world to me. And until next time, have a good one.